The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone and welcome to the ACECRT Financial Wellness Webinar Series. Today we will be discussing taking the pulse of the market using today's wealth for tomorrow's goals. We certainly appreciate all of you taking the time to join us today. A few items to go over before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And at the end, we will take some time to go through these. And now I'd like to introduce our guest speaker from MassMutual, Patrick Kellogg. Patrick is a retirement education specialist and has been helping people understand investments and prepare for retirement for over 19 years. He has been a financial advisor, and he has taught thousands of people across the country on how to create a solid foundation for retirement savings. Thank you for leading us through this webinar today, Patrick. Now I will turn it over to you.
Great. Thank you, Tori, and thank you, everybody, for joining today and letting us participate in this call. We're going to talk about several things today as we go through this presentation. We call it the pulse of the market, changing times for investors, and in a sense, we are taking the pulse. We're kind of seeing where the markets are right now. But one thing I like to start off with, I always like to bring up quotes from favorite speakers, philosophers, important people. One of my favorite philosophers is the baseball great Yogi Berra. Said some of the most interesting things. He said, if you don't know where you're going, you might wind up someplace else. And that's definitely true. So let's talk about where we're going to go during this presentation today. We're going to talk about market performance in recent years, how the markets have performed in different economic circumstances. We'll talk about how you can set realistic expectations for your own portfolio growth. And we'll talk about some things to keep in mind when you're diversifying, when you want to spread your money out. Now, before we get started with any of the details, it's important to understand that everyone's financial situation is different. So during this webinar, we won't be giving financial advice, and that's probably good because free advice is worth about what you paid for it. But we will be getting a pretty good perspective on where we are today in the markets and where we've been, and that'll help you make a more informed decision about where you're going. Now, I'm just like you. I'm investing for my future, for my family, for the things that are important to me. I'm no expert in the markets, but I do have the benefit of experience, and just want to share some of that experience with you during this presentation. So as we go forward, let's take a look at where the markets have been over the past few years. This market shows several different market indices over the past 4 years or so, 2010, 2011, 2012, and last year, 2013. And an index is basically just a basket of stocks. Now, a lot of times when people take a look at the markets, market performance, market indices, a lot of times people want to know, well, what are the markets going to do next year? This is great to see what they've done the past couple of years, but where are they going to go next year? As Yogi Berra once said, it's tough to make predictions, especially about the future. Basically, no one can predict how the markets will perform from year to year. But we use stock market indexes like the Dow Jones Industrial Average, the S&P 500, the Russell 2000, and some of the other ones that we show here. Indexes or indices are frequently used as a measure of market performance. Now, there's limitations, definitely, to any one of these indexes. The Dow Jones Industrial Average, for example, a lot of times that gets quoted every day when you hear the stock market report on the radio or TV. A lot of times they'll say the market went up 300 points today, or the market went down 85 points today. Well, a lot of times when they're talking about that, they're talking about the Dow Jones Industrial Average as if that is the stock market. But that's kind of misleading because the Dow Jones Industrial Average is really an index made up of just the prices of 30 stocks from some of the major industries. But 30 companies, there are over 6,800, there's over 3,600 publicly traded U.S. stocks on an exchange. There's another 15,000 or so that you can buy over the counter. So 30 stocks really doesn't give you a very good indication of where the overall stock market is, but sometimes that's what people use as a small rule of thumb. S&P 500 index, that's becoming much more popular. A lot of times you'll see that quoted as the stock market index. That is much larger than the Dow Jones Industrial Average. It covers 500 of the biggest companies in America, but they are large companies. The smaller companies and foreign companies don't show up in the S&P 500 index. Then you've got different bond indexes to let you know how different types of corporate bonds are doing. There are government bond indexes. The Russell 2000 is an index that shows you how some of the smaller companies, how about 2,000 of the smaller companies that are around $2 billion in market capitalization and under, how those are performing. The MSCI EFA is a pretty good index for international stocks. Obviously, it doesn't have everything in it, but it's got an awful lot. You've got the S&P Commodities Index, and you also have a real estate, the REIT index. A lot of times that will help you see what's going on in the real estate market, at least what the stocks of publicly traded companies that deal in real estate. Now, it's important to have a realistic yardstick of how your investments are doing compared to the relevant averages, these indexes, but they don't tell the whole story in terms of your portfolio. So don't always compare your portfolio to just one or two of these indices. You might have to use a variety of these indexes to measure the performance of your portfolio. And again, this is all rearview mirror information. When we're taking a look and seeing, how the Dow Jones Industrial Average performed in 2012 or 2013, that doesn't tell us what it's going to do in 2015 or 16 or 17. It's just telling us where it's been. And just because this presentation was done up after the end of last year, and that's usually when we update it and see, how did the index perform through the entire calendar year. This doesn't even give us the whole story. Here we are almost at the end of 2014. Just to give you an update, year to date so far, through October or so, the Dow Jones Industrial Average is up a little bit more than 6% this year. The S&P 500 is up a little bit more than 10% this year. The Barclays bond is up about 5%. The NASDAQ, I know that's not on here, but NASDAQ is kind of over-the-counter stock. That's up about 12%, a little bit more than 12% this year. Russell 2000, small-cap stocks, only up about 1.9%. So that's one important thing to take note of is, one stock index or one grouping of investments might do really well one year. You can see that the Russell 2000 did very well in 2013. This year, obviously having a much rougher go of it. Now, sometimes the question comes up, well, what if my fund is underperforming the index? What if the investment that I'm in isn't doing as well as the S&P 500 and it's supposed to be fairly well correlated to that? Well, a lot of questions that can come up there. Is the fund underperformance a short-term issue? Is that fund underperforming just, in the past 2 or 3 months? Has it been underperforming for the last 2 or 3 years? Those are very significant differences. So don't always think that you have to get out of one investment because it might not be performing as well as its comparable index, for a short period of time. If it's a longer-term underperformance issue, then yeah, you might want to take a look at it and see if there's a different money manager that has a similar type of fund in your plan that may have been doing better. Again, there's no guarantee that it's going to do better in the next couple of years, but at least you're not going to make a long-term change based on just short-term performance. And sometimes a fund can underperform the index just because it has a few key holdings, some stocks or some particular companies, they might have a higher percentage of the assets of that fund in one particular company that's having a rough quarter or a rough year. And that can affect the performance of the fund overall, but is that something that you necessarily want to get out of just because of that one or two companies affecting that performance? So taking a snapshot of where we are right now overall in the world, looking at the past few years, looking at where we are, towards the end here of 2014, obviously it's not going to be a prediction of where we're going, but let's take a look at where we are overall. Global growth around the world is definitely slowing, even in China. In China, they're all worried because their GDP growth, the growth in their economy, is only 7.3% this year. And most of us, here in the United States and definitely in Europe, we would love to have that problem of only having 7.3% growth. So China is slowing down from where it has been. It's been over 10% growth in previous years, but it's still growing. So they're still growing even in the emerging markets, but just not as quickly. Long-term growth in emerging markets is still pretty likely, slower than it has been. Europe, developed Europe, is on the verge of a recession again. Some people are definitely concerned about that. Now, the U.S. outlook is looking a little bit better. So far, we've got about 3.5% growth is what we're looking at in our GDP, which is definitely better than it has been in a few previous years. So GDP growth is looking pretty good. Inflation is very low. Even oil prices, we've been seeing oil prices coming down. A lot of analysts are taking a look at where the Federal Reserve is and where interest rates are. They probably won't be hiking rates anytime soon, is what a lot of analysts are surmising. Obviously, we don't know exactly what the Fed will do, but hopefully that'll stave off any inflation here in the near term. The dollar is pretty strong compared to a lot of other currencies around the world. We do have an awful lot of volatility in stocks. We've definitely seen that, especially in October this year. We had a lot of stock market volatility. Volatility just means some days things are up a whole lot, some days things are down a whole lot, and that's probably going to remain with us for a while. We'll talk more about volatility a little bit later. Valuations for stocks are mostly fair. Small cap stocks tend to be a little bit on the pricier side, and the earnings just haven't been as good, and that increases their valuation. Industrial activity is up compared to a few years ago, and employment growth is pretty steady. So overall, things are looking pretty good. Outlook from most analysts, most stock market analysts, is looking pretty positive on U.S. domestic stocks. So let's take a look at volatility. Again, that's the word that nobody likes. Volatility, again, it means that roller coaster ride. The ups and, unfortunately, the downs. What goes up at times will go down. But taking a long-term view, and for this chart, we are using the Dow Jones Industrial Average just because it's been around longer. We can go all the way back to 1897 and take a look at the annual average returns, the annual returns each and every year for the Dow Jones Industrial Average over the past 117 years. Since its inception back in 1896, the Dow Jones Industrial Average has risen on a calendar year basis more than 60% of the time. Actually, it's about 65% of those years. So 65% of the years since its inception, the Dow Jones Industrial Average have had positive returns. 34% of the years have been negative. So anything in blue are the years that it had a negative return. Anything in purple are the years that it had a positive return. And the other thing you can see is, generally the positive returns were anywhere from just above 0%, 0 to 10%, 10 to 20%, and 20 to 30%. That's where most of the positive years kind of fell in that range. Obviously, there were a few years that were outliers that had much better returns than that. The negative returns are mostly between 0 and negative 10%, and then between negative 10 and negative 20%. That's kind of where most of the bad years tend to run. So the short view of this is, the bad years outnumber the good years, and the good years, the returns tend to be better than the bad years overall. No one enjoys the bad years. Psychologically, we just don't like it, those years that the market goes down and our account values go down. But we do have to take the bad years along with the good so that we can get those average returns. Another thing to keep in mind is that we can use periods of volatility when prices are falling to buy selectively rather than sell. If there's one sector of the market that seems like it's gone down and prices look a little bit cheaper than they were last year or the year before, maybe if that's a sector you'd like to be invested in, you might want to buy a little bit more when prices are down rather than selling when prices are down, because then you're basically locking in some of your losses. Some people buy quality during those periods of volatility. Some people invest more in whatever's been down for a while. And that's something to keep in mind because most analysts are taking a look at the markets and expecting that markets are going to be choppy for a while. We're going to have volatility for the next foreseeable future. Even though recessions are unavoidable, over the last century, expansions of the U.S. economy tended to be much longer than recessions. And Newton's law of gravity says what goes up must come down. That applies to the economic cycle in the U.S. and elsewhere. Sooner or later, periods of economic expansion, or booms, decline into temporary slowdowns and recessions. And again, nobody likes those periods of time because a lot of times when the economy is contracting, the stock market is already contracting as well. After enjoying one of the longest periods of economic expansion in U.S. history, from 1980 to 2008 basically, Many investors were unprepared for the most recent recession that we had. As the economy begins to recover, it's easier to put the last few years into perspective. So just looking at different time periods here on this chart, the most recent period, 1980 to 2013, we had 5 different recessions during that period of time. Some were much smaller than others. The average duration of a recession, how long it lasted, was about 18 months. We had 5 expansions during that period of time as well. The average duration of the expansion was about 70 months. Again, this is past performance, doesn't mean it's going to be like that in the future, but that just shows you, at least over history, and you look at just about any time period there on the chart, and the recessions tend to last shorter than the expansions. A lot of it comes down to our attitude and our behavior during these economic expansions and especially the contractions. Sometimes our emotions guide us. A lot of times when we're talking about markets, the stock market especially, we talk about bull markets and bear markets. You've probably heard those terms before. A bull market is generally when the markets are going up. Prices tend to be going up for stocks. Well, people like that. They get excited about that. The stocks that they already own are going up in value. A lot of people get overly excited about that, and they start investing in stocks perhaps at the wrong time when things are going up and up and up, and prices are getting higher and higher. Bear markets are when the markets are going down for a period of time. Stock prices are falling. And a lot of times people get emotional about that, and they see the value of their portfolio going down, and they think, well, now's the time to sell. I got to get out of this. Well, then they sell too late. They're selling low. So a lot of people, when they let emotions guide them, they wind up buying high and selling low, which is not a good long-term strategy. And just to give you an idea, back in March 2009, we'd been in recession, we'd been in a bear market for quite a while, since 2008, when the credit bubble basically burst. March 2009, just a few days before we kind of hit bottom and things started turning around and the current bull market began, a survey was done. They asked individual investors, how do you feel about the U.S. stock market? Are you bullish or bearish? Bullish meaning, do you think things are going to get better? Do you think things are going to go up? Is now a good time to be buying? Or bearish would be, are you pessimistic? Do you think things are going to stay down? Are you not wanting to buy right now? 19%, only 19% of investors were bullish on U.S. stocks back then because things had been down, things had been ugly for a while. That was just before things turned around, though, and the markets have done quite well since March 2009. Just a week or two ago, they did the same survey, and about 58% of investors were bullish. A lot of times we kind of get things wrong. We get the wrong idea at the wrong time. So a lot of times the best time to get into investments and get into the markets are when things look the worst. So just keep that in mind. Fear and uncertainty during economic recessions might lead you to make short-term decisions that could impede your long-term financial goals. What are your long-term financial goals? Everybody's got different ones. You might want to retire with dignity. I think we all want to do that. Retire with enough money to last as long as we're going to live and provide you with the standard of living that you deserve to have to be able to buy not just the necessities of life, but the things that you'd like to do as well. Maybe a second home. Maybe you want to do some traveling. Maybe you want to pay for college for some loved ones. You might have different goals than the person sitting next to you, but everybody's got long-term goals. You want to make sure that you're not making short-term decisions that kind of derail those long-term goals, because those decisions might actually lock in your losses during a recession. History shows that when investors get panicked and they stop investing during recessions, they wind up missing out on the market upswings during the recoveries that follow, and we'll see that in a few slides. But since World War II, what we see on this chart here, the U.S. economy has experienced 11 recessions since World War II. Typically, the S&P 500 index has rallied in the 12 months immediately after each recession. Now, it doesn't always do that. The most recent time that we see that is back in 2001. Markets didn't go up right after that. It was a longer period of recession. But most of the time, when the recession happens and the month the recession ends, the stock market has rallied in the next 12 months, and sometimes pretty good, by a pretty good amount. The thing to keep in mind here is that if you're waiting, next time we have a recession, next time the economy contracts, if you are waiting for an all clear signal that the recession's over, everybody, get back in the pool before you jump back into the market, you risk missing out on a potential rally. Stock prices may start to rise as soon as economic conditions begin to improve, not when the recessions are declared officially over. The economists don't officially declare a recession over until we've had 2 quarters in a row of positive GDP growth. So you might be late. It's kind of like the beach ball. When you hold the beach ball under the water and it's kind of pushing, straining to get back up, well, when you let go of that beach ball, a lot of times it bounces back up. That's a lot of times what the markets do after they've been down for a while and after the economy's been down for a while. So you don't want to miss out on that recovery. So make sure that you always stay invested rather than trying to time the markets. And then it's important to maintain realistic expectations of what kinds of returns we're likely to get. And if you just take a look, some people think long-term is 10, 15 years, right? Well, if you take a look at the bottom set of bars here, these are the returns of different types of investments since the year 2000, from 2000 to 2013. If you take a look, the light blue bar there says that stocks, the stock market, the S&P 500, averaged about 3.5% during that period of time, from 2000 to 2013. Bonds, on the other hand, averaged quite a bit better, 5.7%, and cash did about 2%. And when you figure, all right, inflation's usually around 2 to 3%, sometimes higher, sometimes lower. Well, you take a look at this, and that's 13 years. That's a pretty good long period of time. You might be tempted to think stocks are a lousy investment. Bonds are always going to do better. I'm just going to put all my money into bonds. Well, take a step back and take a little bit longer term view, and let's go back to 1970. From 1970 all the way through 2013, now we're talking more like 43 years, stocks average a little bit better than 10%, bonds average more like 7, almost 8%, and actually bonds were having a much better, they had about a 30-year bull market because interest rates were falling during much of that period of time, and cash did about 5.3%. What that basically shows me is that stocks can be a pretty good hedge against inflation. They can beat inflation pretty well, and so can bonds. Sometimes stocks are going to do better than bonds. Sometimes bonds are going to do better than stocks. Most of us should have some of both, stocks and bonds, if we're trying to beat inflation over the long run. Now, many of you may have heard of the rule of 72. It's a mathematical rule. Basically, what it helps you do is figure out how long it takes to double your investment. What's the length of time that might be necessary for you to double your initial investment? So here's how it works. You take 72 and you divide it by an investment's potential rate of return. So let's say you have assets invested in some type of investment. Maybe it's a CD, maybe it's a cash account. Let's say that CD is yielding about 1.6%. That's its annual return right now. So you take the rule of 72, you divide 72 by 1.6%, and that tells you that your initial investment would double in size in about 45 years. 45 years, that's longer than most people have. Looking at the chart, let's say your investment's earning about 2%. 72 divided by 2 is 36 years. I might not have 36 years until I retire. I might need to earn a little bit higher rate of return. If I could earn more like 4% of my investments, 72 divided by 4 is 18. All right, that will take only 4 years to, that would only take 18 years to double. If I could earn something more like 7%, then I could double my money in roughly 10 years, 10.3 years. So again, the higher the rate of return, the less time it should take you, all things being equal, to double your money. So that's a helpful rule of thumb to use to compare hypothetical rates of returns and how long it's going to take to double, and maybe even more than double your investment, because that's what we're trying to do, is grow our nest egg so that the nest egg will be big enough to provide us the income that we need during retirement. Don't play it too safe. Investors that have experienced losses sometimes are tempted to move their money into so-called safer investments. That may prove a riskier move than they imagine. This chart shows you some hypothetical losses, and based on the latest 30-year average annual returns, shows you how long it may take you to recover if your money is in T-bills, which is kind of like putting it in cash, bonds, and stocks. So let's say, I lost 10% in my portfolio. I need to earn about 11.1% to break even. If I'm in cash, using the returns from T-bills for the last 30 years, that would take me roughly, approximately 2.6 years to earn back my money. Whereas in stocks, it would only take about 1 year, about 1.3 years in bonds. But the bigger the loss suffered, let's say I lost 40% of my portfolio, I would need a total of a 66.7% recovery to break even. It would take me about 12.7 years to break even if I'm in T-bills or in cash. It would take me a little bit more than 6 years in bonds. It would take me just under 5 years in stocks. Again, that's using historical rates of return. We can't assume that we're going to get those returns over the next 3, 4, 5, 10 years, whatever. But that just tells you historically, some people, by moving it all into cash or something like T-bills, Treasury bills, they might be trying to play it a little too conservatively, and they might actually take longer to recover from their investment losses. Investing the same amount at regular intervals is something that we call systematic investing, or sometimes you'll hear the term dollar cost averaging. So putting money in, same amount of money at regular intervals. Maybe some people are investing every month. Or if you're in a retirement plan, you're probably investing every pay period. You have the same amount coming out of your paycheck, going into the funds that you're investing in. We call that dollar cost averaging, just a fancy way of saying, I'm putting the same money to work and buying, whatever the price happens to be when my money goes into the market, when it goes into the investments that I'm purchasing shares of, I buy it whatever the price is. That may be a better way to work towards your long-term goals. Dollar cost averaging has historically worked especially well in volatile times when the markets are bouncy. Making investments of a fixed dollar amount at regular intervals allows you to buy more shares when prices are lower and fewer shares when prices rise. And over time, dollar cost averaging can lower the average price per share paid and can help you smooth out the effects of volatility in your portfolio. The example that we've got here is a lump sum investor, someone that's got $1,200 in their pocket, or maybe it's already in their 401k plan. They move it out of their cash account and they put it all to work into an investment, and they buy all the shares all on day one, January 1st. So they go out and on January 1st they buy a whole bunch of shares, 120 shares of the fund that they like. It's $10 a share, and then the markets do what the markets do. First part of the year, market was going up. Price of the value of your portfolio went up. Second part of the year, prices started going back down all the way through July. Then things kind of bounced back a little bit. Prices came back up. At the end of the year, this person still owned 120 shares. That's what they bought on January 1st. Average price, they paid $10 a share, and everything's back to the $10 original purchase price. So at the end of the year, they've got the same $1,200. That's what their account value is worth, right? If we're dollar cost averaging, what we wind up doing is we're buying shares every single month. We're putting, instead of $1,200 all at once, we're doing $100 a month. And we're buying as many shares as we can each year based on each month based on what the price is. So when prices are $10 a month, we buy 10 shares. Then prices go up because the market's going up. We buy fewer shares when the markets are on the rise, when prices are going up. But then look what happens when the market starts coming down. Every month when we got money going in, we're buying more and more shares. And you can see in July when the market's down quite a lot, that's when you buy the most number of shares. Get to the end of the year, markets have basically recovered to where they were at the beginning of the year. And so now I own 144 shares as opposed to only 120 because I was able to buy more when they were on sale. I bought fewer when they're priced higher, that's true, but I was able to buy quite a few more when the price was lower. And my average price wound up being lower because of that as well. So dollar cost averaging, systematic investing, it doesn't assure you of a profit. It doesn't protect you against loss in declining markets, but it can be a pretty good thing to do during volatile times just to increase the number of shares that you have. And to me, that's one of the biggest keys of long-term success. How many shares do you own of the investments you're trying to purchase for the long term? Because especially if you've got a long time to go until you retire, 10 years, 15 years, 20 years, the likelihood is pretty good that the shares that you own today should be worth more in the future, 10, 20, 30 years down the road. And that's why you want to have as many shares as you possibly can. Now, we talked a little bit earlier about keeping that long-term focus and not getting scared out of the markets. Maintaining that long-term focus on your investments, it's not always easy, but it can be rewarding over time. Economic news, different events, bad things that happen, those can be distracting for any investor. And you take a look in the 80s, in the 90s, in the new millennium, there are lots of bad things that have happened. Presidential assassination attempts, the U.S. becomes a debtor nation, Gulf Wars, we've had several wars, we've had terrorist attacks, we've had all sorts of things. Each time that one of those bad things happens, a lot of people are saying, now it's time to get out of the market. Now's the time to go someplace else. Let's go into something safe. Consider October 19th, 1987. If you take a look at on the chart here, try and find 1987, right around there, the Dow Jones Industrial Average dropped more than 20% in one single day, October 19th. That was the worst one-day decline in over 60 years since the Great Depression. Now you take a look, and that day basically appears as just a little blip on the screen in the overall history of the stock market success. So what this graph is showing is way back in 1980, if you took $10,000 and just lump sum invested it in the market, in the S&P 500, and just let it ride, every time the markets went down, yeah, the value of your portfolio dropped too. And sometimes it dropped quite a bit. Then when markets went up, it went up. But sometimes what goes up goes down, but you just stayed with it, you stayed the course, and at the end of that long period of time, from 1980 to 2013, your $10,000 grew to about $426,383. Now, let's say you didn't have as strong of a constitution, you weren't as adventuresome, and you said, all right, anytime the markets are getting bad, I'm heading for the exit. So instead, every time the market dropped by 20%, you cashed out your investment. So right here, you cashed out your investment, got out of stocks, and put your money into 90-day T-bills, basically into cash. And then you parked it there for 1 year, just wait until the dust settled, until things got better, before you got back into the market. Then your $10,000, moving into stock or moving out of stocks into cash, and doing that every time there's a 20% correction. By the end of that same period of time, instead of having $426,000 and change, by moving into T-bills every time there was a bear market, you would have had about $240,371. Still a pretty good return for that long period of time, but not nearly as much. It's about 44% less. So the thing to keep in mind, you want to keep that long-term focus. Well, how do you do that? Just tell yourself there's always going to be bad news, but bad news doesn't last. As long as there are companies out there that keep coming up with products and services that the world wants, then long-term growth will continue to outpace bad news. So you just have to keep that long-term perspective. Now, another thing to keep in mind is diversification. Diversification is another one of those fancy words that sometimes we use in this industry, and all it simply means is don't put all of your eggs in one basket. Don't put all your money in one type of investment, especially just because it's been hot recently. That's not a reason to put all your money in there. Some people try and do that. They try and time the market. They look for what's hot right now, and they move all their money into that. Well, what's the problem with that? This chart's showing you from 2003 through 2013, basically what the best performing asset class or type of investment. Some large stocks, small stocks, international stocks, bonds, real estate, commodities, etc. What was the best performer each and every year? That's the colored box on the top row. All the way down to the bottom box, the bottom row would be the worst performers in each calendar year. And what you can see is that the top performers changed quite a lot, pretty frequently. And what's hot one year, for example, 2005, commodities, great place to have your money invested. That was the bottom. That was the worst place to have your money the next year, 2006. 2007 was back on top. 2008, commodities were back on the bottom. Of course, 2008, pretty much everything was down. But that just goes to show you that what's hot won't remain hot for long most of the time, and it can change pretty rapidly. And if you're trying to time the market, I don't know anybody that can consistently time the market, because by the time you hear, hey, this type of investment is doing really well, whether it's real estate or large company stocks or whatever, by the time you hear about it and you decide to move into it, you've already missed out on most of the gains. And usually by the time people that time the markets get into an investment after they've heard about it, that's about time for it to start dropping. So they wind up buying high, and then it starts dropping, and then they wind up selling low. That's kind of a long-term recipe for disaster. So a much better option, a much simpler option for most of us, unless you want to devote your entire day to trading on the markets and trying to get in and out. Most people don't have the time or the inclination to do that. If you notice the white boxes across the middle of this chart, that's a diversified portfolio. And for simplicity, all we did to get this diversified portfolio is we just put an equal percentage in all the other categories: large stocks, small stocks, international stocks, bonds, commodities, etc. And the one thing you notice about the white boxes, the diversified portfolio, is they're never at the top. It's never going to be the top performer in any given year. Because mathematically speaking, if we're averaging everything out and we've got a little bit in everything, it's not going to be at the top. But it's also not at the bottom. It gives you, for a diversified portfolio, winds up giving you a pretty consistent middle-of-the-road returns. And usually, in most years, especially in the long run, a diversified portfolio will give you the growth that you need to stay ahead of inflation, which is what we need to be doing. We have to make sure that our returns are better than the rate of inflation. But you wind up not taking on so much risk by putting all your eggs into the wrong basket at the wrong time and blowing up your portfolio. So by diversifying, by spreading your money out and being in all the different categories of investments that you can be in, at least the ones that make sense for you, whatever goes up that year, you've got some of your money in whatever goes up. Whatever goes down that year, you only have some of your portfolio in whatever goes down. That's what diversification is trying to do. And again, it doesn't guarantee that you're not going to have a loss in any year. For example, 2008, when pretty much everything went down, the diversified portfolio went down, but it didn't go down as much as some of the other individual components, individual types of investments. So one thing to keep in mind is, most retirement plans offer more than just stocks and bonds. You might have real estate, you might have some precious metals or some other commodities, or you at least might have some individual funds in your retirement plan that offer some of those different types of investments. There's definitely extra risks involved in some of these things, but it might help you also diversify and add to just your stocks and your bonds. Another thing to keep in mind when we're talking about diversification is making sure that you're broadening your investment horizons to include investments outside of the United States. International financial markets today are much larger, much more accessible to U.S. investors than they were just a few decades ago. The dramatic growth in the size and the scope of the global financial marketplace has brought a corresponding increase in international investment opportunities. So this may help you by spreading your money out, some of it overseas. It might help you mitigate your overall portfolio risk. You can include some of the best companies in the world that aren't going to be reflected in U.S.-centered funds, and it might help you improve your long-term portfolio performance. Over the last 10 years, what we can see on this chart here is that the United States has been one of the top 5 performing developed markets only twice. Only 2 of those 10 years has the U.S. been in the top 5. So a lot of growth is happening in other parts of the world. Now, granted, it's not always rosy. There are some different expenses and risks sometimes in investing overseas in foreign securities, currency fluctuations, foreign taxes, political, economic factors, but overall, it's a good place to at least have some of your money. Now, keeping in mind what we said before, right now in Europe, things may not look rosy, but a lot of times, like we were just talking about, sometimes that's the best time to buy is when things aren't looking the best. Make sure that you're thinking long-term, buying low and selling high. So let's wrap this up. Let's talk about some takeaways, things that you can think about and act on to help with your retirement planning. And again, I know everybody's situation is a little bit different. I encourage you to take a close look at your portfolio and see if anything that we've talked about in this presentation might help you. Again, make sure that you're maintaining realistic expectations about market performance and returns. That's why we're looking at the rearview mirror information. That's why we're taking a look at how the funds or how the different indexes have done over the past few years. But again, that's not going to guarantee what they're going to do in the future, but make sure that you're expecting realistic returns. Don't expect to get 25% a year from the stock market. That's very rare that that is going to happen, other than perhaps one calendar year once in a while. But also don't expect it to be too negative, too unfruitful. Have a realistic expectation. Take a long-term view of where you're going. What are your goals? What's your risk tolerance? What's your comfort level with the dips in the market? You want to make sure that you're investing your money in the right mix for you, for how comfortable you are. You want to make sure that you're getting enough growth so you can beat inflation and grow your money over time to provide you with the income that you need in retirement. But you don't want to take on so much risk that anytime that there's a fluctuation in the market, anytime the markets take a little dive, you don't want to get scared out. You want to make sure that you can sleep at night. So make sure that you've got a good mix for who you are. Don't try and time the market. No one can do it consistently. Keep in mind, good times don't always last, but neither do bad times. Diversify your portfolio. Have a deep bench. In any sports team, you want to make sure that you've got a lot of good players in every position. So make sure, maybe even in just one investment category, maybe large cap stocks, you want to have a few good funds. One manager might not have a great year this year, but another large cap manager might do pretty well. And then start your investment program early. Start saving as early as you possibly can, as young as you possibly can. And then make sure you keep investing regularly. Like we were talking about with dollar cost averaging, keep putting that money in every single pay period. Don't stop just because the markets are getting choppy or getting, having negative returns. That, a lot of times, is the best time to keep investing. And make sure that you're investing enough. Most financial experts have said for years that we should be saving about 10% of our pay if we want to get to retirement and have enough to live on comfortably. Nowadays, most of them are saying more like 15 because of the volatility that we had over the last recession. Make sure that you're saving enough. And if you can't save 10 to 15% right now, then save as much as you can. And then just make a commitment, I'm going to bump that up a little bit each year. Work with a financial advisor that can help you answer some of these questions. And then the last thing I'll just close on, again, we'll come back to Yogi Berra. He tends to say things better than I can. One of the things he said is, it gets late early out there. And it's true, it gets late early out there. Retirement will be here before you know it. And that's what every person I've talked to that has retired has told me. I wish I would have started earlier. Retirement got here, kind of snuck up on me. I wish I would have saved more to be able to have a more comfortable, worry-free retirement. Make sure that you don't have any regrets. So with that, I think I'll close and open up, see if we've got any questions, I guess. Tori, any questions that are out there?
Yeah, great. Thank you so much, Patrick. We really appreciate you sharing your time and knowledge with everyone here today. And we're going to go ahead and start addressing some of those questions that have been filtering in. Please remember that there's still time. If you have any questions, you can submit them using the Q&A tool on the webinar menu. And as always, you can reach out to your ACECRT's Financial Wellness Program. Our first question, what is a good resource for tracking the market for the average person?
Great question. There are different things that people will use. Yahoo Finance is a pretty good one. If you've got an account with a major brokerage firm, and a lot of times even if you don't, a lot of them have some free tools available on their websites. Those are things that a lot of people use. I tend to use Yahoo just to keep tabs on where the market is. But the one thing I don't really do is I don't check my portfolio too frequently, to tell you the truth. I take a look at my quarterly statements. For most people, that's one of the best ways to take a measurement. Sometimes I don't even pay a lot of attention to those. I tell the story, and it's completely true. Part of it's my personality. Part of it's just, what makes sense to me. But anytime that we're having a really ugly time in the markets, a bear market, prices are going down, I do not open my statements during those periods of time. There's a lot of good information in there, I'm sure, but I don't want to open it up and have a negative reaction to what I see. Some people have an allergic reaction to seeing minus signs on their statements, and if that's you, sometimes you might want to just file those away. I'll look at them later when the markets have recovered. But yeah, a lot of pretty good tools online. Yahoo Finance is a good place to start, and some different investment companies and brokerage services can definitely help you out as well.
Thank you, Patrick. Our next question is, what makes for a good return?
Well, a lot of different things, and really a good return is very relative depending on what you're looking at. A good return for a bond fund is completely different than a good return for a stock fund. So a good return is, in my opinion, good return is an asset class or a fund in an asset class that's doing what it's supposed to be doing over the long run. Bond funds, long term, if it's basically corporate bond funds, I'm wanting to get a good 5 or 6% long term out of my bond funds. That doesn't mean that they have to do 5 or 6% every single year. There are definitely going to be years that they go down in value. But I want to take a look back at the last 5, 10 years of that bond fund and see, hopefully, 5 to 6% returns. If it's a large company stock fund, and that's all it's investing in is just large company stocks, I'd like to see about a 7 to 8% return. I love it when I see better than that, and a lot of times you do, but I'm going to be pretty realistic and say, all right, I'm trying to beat inflation over the time. I want to make sure that they're getting some earnings growth, and if a large company stock fund can give me more like 7 to 8% return over a period of time, then I'm usually pretty happy. And a lot of times I'm going to be happier than that. So again, kind of going back to what we started out with when we talked about the different indexes, I'm going to compare it to the index. I'm going to see how it has done compared to that index over a period of time. And just I want to try and see that it's beating that over the long run.
Thank you, Patrick. Our next question is, how often should you rebalance your portfolio?
Yeah, that's a really different, there's a different answer for that for everybody. Some people have different philosophies. Some people say, hey, rebalance that every single quarter, every single 3-month period if your plan allows you to automatically rebalance, and a lot of plans do. Some people say, every 3 months I want to rebalance back, and for anybody that's wondering what that means, rebalancing just simply means, whatever percentage you wanted to have in all the different investments in your portfolio, in your 401k or 403b or whatever it happens to be, you want to reset yourself back to those same percentages so that you don't get overweighted in some of the funds that did really well, and you don't get underweighted in one of the funds that hasn't done as well recently. I rebalance mine about once a year. To me, a year gives me a little bit more time to let the markets kind of go through the cycles that they tend to go through. And you could even do it less frequently than that, but I tend to rebalance mine about once every 12 months because that seems to be about right for me. And again, the reason I'm doing that is just because I don't want to be, have too aggressive a portfolio because, hey, this fund has done really well, and instead of being 20% of my portfolio, now it's 25%. Well, that might be increasing my risk level a little bit. I might be taking on more risk by having more of my assets in that one fund. I should dial that back down to the original percentage I wanted to have.
Thank you, Patrick. It looks like we have no more questions at this time, so this will conclude our webinar session. Thank you again, Patrick, and thank you, attendees, for your participation. I hope everyone has a great day, and we're looking forward to our next webinar series with you. Happy Thanksgiving, everyone, and take care.
Thank you.